thank you for attending the 2014 Halftime Report. You know, last year at this time we asked the questions, is the recent surge in the market sustainable? Should I take my money out of the stock market? What should I do now? Is it time to panic? A year later, I'm hearing these same questions. So I'm glad you're here today. We're excited to bring you up to date. We're going to talk about what's going on in the markets, the economy, and global events, and then look at what actions we are taking in your portfolios and try to make some sense of what's going on. Today's agenda, we're going to talk about words we've learned, where we've been, where we are, and what to watch for. Now, the focus of today's event is going to be on the economy and investing, but remember, they're only part of a well-thought-out wealth management plan. You can have the best investments in the world, but if the other parts of your wealth management plan aren't in order, then your investments won't do you any good. And that's why we place such an emphasis on wealth management and work with a team of experts on advanced planning issues such as wealth transfer, wealth enhancement, wealth protection, and charitable giving. Also remember, we're going to be speaking about a lot of concepts today, so it's important to remember that you have to have an investment strategy which focuses on managing your portfolio volatility to a level consistent with your unique goals and circumstances, which goes hand in hand with our mission. We want to help you make smart choices with your money so you can worry less and ultimately be a better steward with the resources God has entrusted to you. So let's get started with some words we've learned. The first word that's been in the news a lot lately is ISIS. Here's a few ideas of what it may be. I like number 2, but no, it is number 3. Islamic State in Iraq and Syria, which has been causing a lot of problems. It's been in and out of the news. Here they are, a very nasty group of individuals. I love the white tennis shoes. Apparently they didn't get the message that it's important to work those shoes out a little bit before you put them on in public. Let's talk about the next word, yelling. A few Aggie fans out there, could be what your Aggie Yell leader does. But no, it is the current chair of the Federal Reserve, and here she is, not looking too happy here. We hope she has a good year, because the Fed plays a very important role in our economy, or at least they think they do. So we're going to talk a bunch more about the Fed's thoughts and actions a little bit later. For the next part of the presentation, I'd like to introduce Dudley Simms, the newest member of the Chessman Wealth Strategies team. Hopefully most of you have had a chance to meet him. He brings a wealth of experience and knowledge to the firm. He had his own business for many years and has worked at Merrill Lynch and J.P. Morgan. In addition, Dudley is a chartered financial analyst. This is a coveted designation that certifies a deep technical knowledge of financial concepts and instruments. The program is comprised of 3 levels, each culminating in a 6-hour exam. And these are tough exams. As a matter of fact, the level 1 test pass rate is only 38%. Let me introduce you to Dudley Simms.
Thank you, Wade, and I want to thank everyone else for making me feel so welcome as the newest member to the Chessman team. I know a lot of y'all have been clients of Wade's for quite some time, and so you've been very welcoming to me, being the new guy at the firm. What I'm going to do is review a little bit where we've been. As you know, these are performance numbers. You'll see right off we have them through June 30th and then also through August 1st. So a lot took place between June 30th and the beginning of August. You notice right off that the market went down quite a bit during that time period. Also want to point out that the difference in the size companies, how they performed throughout the year. The S&P, that gets a lot of the headlines and where the majority of the focus is when people talk about what the market has been doing. As you see, it's up a little over 4%. But if you go down a little bit, you'll notice that the smaller the companies are, they haven't performed as well this year. In fact, if you are invested in small companies, you'd be down almost 4% or over 4%. International and emerging markets are down a little bit. Those kind of point there is emerging markets actually doing a little bit better. The 10-year Treasury's holding its own at 2.5%. Gold, 7% for the year. This last line, volatility index, you notice through the end of June it was down 16%, and then a few weeks later it was up 24%. So we'll be taking a look at that a little bit later in our presentation. I think it's always fun and interesting to go back and see what the so-called experts thought would happen and then check it out against what actually happened. So our expert on the economy here is, again, Janet Yellen. At the end of the year, she forecasted that an upcoming year would be a strong year. We'd have maybe about 3% growth in GDP with no negative quarters. I also wanted to point out the most important thing about this slide is her scarf. If you notice, she's wearing the exact same scarf she was before. So it must have been picture day at the Fed. And she said, okay, let's get a pleasant-looking Janet Yellen. Okay, let's get the angry Janet Yellen before. So just keep a watch out when you see pictures of Janet Yellen. Check out her scarf wardrobe. But she predicted no negative quarters. What happened in the first quarter? Well, we were down. We were down by almost 3% in the first quarter. Well, she just missed it by 6%, and that's equivalent to about $1 trillion. The head of the St. Louis Fed, James Bullard, said, I haven't been right with a forecast in years. I love this guy's honesty. The Fed has now been incorrect with an economic forecast for the last 16 consecutive quarters. These are some of the smartest people that we have. They have all the information before anyone else, and they still can't get it right. It's a tough job they have. Here we have experts' chart of where they thought the S&P would go this year. As you'll notice, they are a little bit all over the map, from flat to up 12%. So that is encouraging that most of these folks think will be positive this year. Most investment experts predicted a rise in interest rates in 2014. Now this has been the surprise of the year for the economy. Decreasing interest rates this year was a huge surprise. Almost everyone thought that rates would rise. Okay, why did everyone think that rates would be higher this year? So a little review here. Rates were at historic lows, so everyone said they had to go higher sometime, so this was it. Or they thought the economy would be picking up, rates, inflation would go up, but we had a slow start to the year, as we pointed out. And the Fed will stop keeping it low, they'll stop buying bonds. They're still buying bonds, they've slowed down a little bit. So interest rates did not do what everyone expected. One of the reasons for this is that China has been buying huge amounts of U.S. treasuries. China now holds 11% of the U.S. debt. And why is China buying? They're hoping to weaken their currency to make their products more attractive to us, the United States buyers. This is just a good reminder that the economy is complicated and there are a lot of factors that affect it. Okay, here's one expert, Bill Gross, who got it right. He said that the rates would not rise this year. Well, at Chessman Wealth, we don't try to predict interest rates. We look at our indicators and find opportunities that we can take advantage of. Example of this is early this year, we bought long-term corporate bonds. This is not where you want to be if rates are rising as everyone expected. However, we had a strategy and stuck to it. We had a nice profitable trade. And we've already talked about this, but this is why we emphasize planning. It's difficult to predict the economy, rates, and the market. One of our jobs is to keep you focused on the main thing. This is helping you identify your desires, needs, wants, your long-term goals, create a plan, and helping you stick to the plan and eliminate all the noise that you hear. All this stuff's fun and interesting, but it can become noise and distract you from your goals. In the long run, it won't dictate your success as an investor. The key to successful investing is discipline. Discipline to stay with your plan and keep your goals in front of you.
Let it go, can't hold it back anymore. Let it go, turn away and slam the door.
Okay. If you have kids or grandkids, surely you have heard this song and you've heard it a lot. Okay, does anyone know the name of the snowman or the movie? Okay, of course, this was from the movie Frozen, and our little snowman friend, his name's Olaf. Well, I want to tell you a little story about how I first heard about Olaf. I was in my car, I was changing radio stations, I came across an interview with the animators of the movie. All they were talking about was Olaf. And they had all the creative things they could do with him, how much fun they had on this project, and they just were so enthusiastic about this movie. Well, I was sitting there listening to the interview, I thought the whole movie was about Olaf. So this would be great for a family to see. So we went to the movie, sitting in there, and Olaf is not showing up in the movie. In fact, I even nudged my boys next to me and said, okay, where's the snowman? Where's he going to show up? Well, it was probably well into the movie before Olaf shows up. And I finally discover that this movie is not about Olaf. It's about these two sisters. So what happened? I was focused on the wrong thing. The snowman was not the main thing. He was funny and interesting, and he added some good things to the movie. He was not the main thing. This is our challenge, to keep focused on the main thing. Okay, so why do we have Olaf in our presentation? Well, he's here and he's trying to tell us that we had the coldest winter in 25 years, and this affected our economy. Remember I said Janet Yellen got it wrong about the economy? Well, this is one of the reasons she got it wrong. This last January was the coldest in 25 years. The first quarter of any year is sensitive to the weather. When the temperature's up, the economy does better. When temperatures are down, the economy goes down. Okay, now how bad was it? Well, it was the 17th worst quarter in our history. When the revisions of first quarter growth rate of the economy, as measured by the GDP, were released, everyone was stunned. The U.S. economy actually shrank by almost 3% in the first quarter. As you'll see by this chart, only 16 times in the entire history of the U.S. economy have we witnessed a worse contraction. According to one of the research firms, there has never been a case where the U.S. economy has contracted by more than 1.7% in a single quarter, and we didn't fall into recession. Is this bad news? Well, maybe. However, we think that a better indicator of where the economy is headed is the leading economic index. The GDP, as we know, is backward-looking. This index is forward-looking. In the 50 years of the index, we have never gone into recession when the index is rising. And you can clearly see that the index is moving in the right direction. Fed stays the course. The Federal Reserve has continued down the path of buying fewer bonds each month and will stop buying probably by the end of this year. Or it is vital to understand that this doesn't mean the Fed is tightening or planning to actually raise interest rates. The Fed is simply buying less bonds each month, but has no intention of selling what they've already purchased. Interest rates will likely remain somewhat suppressed until the Fed reverses course and begins selling what they have. And they can sell a lot. However, this will not happen until economic growth is clearly improved. Bull market rages forward. Okay, this was a very popular slide until a few weeks ago. As you know, we talked about the market has dipped down somewhat. But even though the economy had a weak start, stocks continued to rally. And why was this? Corporate revenues and profits have been up. The global economy has been growing. Investor sentiment has increased. And also the low bond rates have encouraged investors looking for higher returns to invest in the stock market. Some of you said they're forcing the market to find better returns. Okay, here's the path we've taken. We notice that it is not a straight line. So this is normal. This is a normal-looking market. Even with volatility being low this year, you'll notice that there's a lot of ups and downs to it. Particularly, I want you to pay attention to the end of January, first part of February. The market was down almost 6%. I don't know if any of y'all remember that, but there was a lot of concern back then. So we took action with a small part of our money. Our short-term indicators said this was time to move some money out of the market, and we did. Actually, it turned out to be a false read, but we got back into the market, full invested, and been off to the races since then. However, I will note that just last week, short-term indicators said it was again time to take some money out of the market, which we did and went short the market on a portion of our equity allocation. All-time high. This was a concern for most people until maybe a couple weeks ago. But I want to point out that new all-time highs have again been set this year in S&P and the Dow. The common question is, now that we've hit all-time highs, would it be crazy to get into the market? Well, this is what happens in a bull market. All-time highs are set. And people love to worry. The market's up, worried that it will go down. The market is down, worried that it will continue to go down. We don't get out of the market just because it hits a high. The S&P has hit over 100 new highs in this rising market. Now, you would have missed some nice gains if you got out at the first high, or if you never even got in. Now, the classic example of this all-time high panic was Alan Greenspan back in '96, when he said that the NASDAQ 100 was overvalued at 835 when it hit a new high. He said it was irrational exuberance. Well, 3 years later, it was even higher, over 4,700. There were some very good gains after many smart people thought the market was too high. However, we also remember what happened after it hit 4,700. 2 years later, we saw 835 again. Well, so what's the point? Well, I want you to hold that question, and I want to show you a video.
This man right here is my great-grandfather. He's the first cat herder in our family.
Herding cats. Don't let anybody tell you it's easy.
Anybody can herd cattle. Holding together 10,000 half-wild short hairs, well, that's another thing altogether.
Being a cat herder is probably about the toughest thing I think I've ever done.
I got this one this morning, right here, and if you look at his face, it's just ripped to shreds, you know?
You see the movies, you hear the stories, I'm living a dream. Not everyone can do what we do.
I wouldn't do nothing else.
It ain't an easy job, but when you bring a herd into town and you ain't lost a one of them, ain't a feeling like it in the world.
UDS, managing the complexities of the digital economy.
Well, what's the point? Well, the point is that we have a plan and strategies in place that will help us profit on the upside and protect us on the downside. As you see, we have many different strategies. We have our long-short. This is an example of the strategy I talked about earlier beginning of the year and just last week, where our indicator said it was time to go to market. We would short the market. This is our shortest, most active strategy. We have our sector rotation. We're looking for the best areas of the market to be in. We have our calendar days, where we're invested only in historical best days in the market, which is only about 72 days out of the year. Then we have our bull bear. This is one of our longest strategies. We tend to ride out the cycles longer. The idea is to blend multiple strategies together like a recipe in order to be in a position to perform well in many different markets. No single strategy is going to be in favor all the time. So we will continue to remain diligent about our investment and risk management process. Okay, bonds are also rewarding. We talked about stocks have been rewarding. Now bonds have also been rewarding this year. As we said, the consensus coming into 2014 was that the Federal Reserve pumped the brakes on quantitative easing by buying less bonds, and the economy improved. Interest rates had to increase, and therefore bond prices would go down. Remember, rates up, and then prices go down. However, the opposite has occurred. The yields are down, and the prices are up. Even considering the high growth of stocks since 2009, high-yield bonds have actually still outperformed stocks. On average, from the beginning 2008 through the middle of June. Okay, alternatives. Alternatives have rewarded investors. Remember, this is the third piece of our asset allocation. We have stock, bonds, and alternatives. Many alternative investments involve significant risk, but they can provide potential benefits to an investment portfolio. These potential benefits include increased liquidity, diversification, tax efficiency, and historically low correlation to traditional markets. That's not to mention a good, solid return. What are some opportunities that we are seeing in alternatives? Well, we like in real estate the multi-tenant. Multi-tenant retail assets tend to be more stable than other types of commercial real estate, yet they allow for growth opportunities in a recovering market. A needs-based shopping center usually consists of a large anchor tenant, like a supermarket, that brings customers to the property, along with a number of smaller but well-known supporting tenants into the other spaces. The anchor generally has a long-term lease that stabilizes cash flow to the property. The smaller tenants typically have shorter leases, usually between 1 to 3 years, that upon expiration can be re-leased and increase rental rates that will increase the property's income. Another opportunity we like in real estate is the healthcare properties. Has anybody spent money on healthcare this year? I think we all have. Healthcare real estate properties are positively affected by long-term strong demographics. I hate to admit it, but we are not getting any younger. The U.S. is aging. The first baby boomer turned 65 just 3 years ago. Now, healthcare expenditures are 18% of the GDP and will increase to 20%. Job growth in healthcare is also projected to grow in the coming years. The demands will still be increasing for high-quality hospitals, senior housing, or assisted living and medical office buildings. Another opportunity that we'd like to see is in lending to middle market companies. Business lending has greatly changed over the past 15 to 20 years. I like to call this the Pac-Man chart. As you'll see, take notice of the gray areas of the chart. Those are the large and giant companies. Well, 20 years ago, they only made up 40% of the banks. Now, as you see in the chart on the right-hand side, they make up over 80% of the banks out there. So large banks like to lend to large companies as opposed to small or mid-sized businesses. There are fewer and fewer banks for middle market companies to turn to. Add in all the regulatory changes in the banking that resulted from the financial crisis of '08, and we have a lack of supply. However, the demand is still there for these companies. Whenever supply and demand are out of balance, there is an opportunity. Private lending has stepped in to fill the gap. Now we have a treat for you. We get asked a lot about the process we have for investing, so we brought in some cameras and did a little bit of filming to give you a behind-the-scenes look at how you invest your money.
Peter, come take a look at this.
Mr. Daniels. Look at this. What's this?
The numbers, they keep getting bigger and bigger.
The clicks are off the charts.
Yeah.
Yoshi, it's Walter. We're back.
Yes, sir! More shifting! I need more trees! More trees? I'll get you more trees!
Hey, take a look at wood pulp.
Whoa. Everything you got on wood pulp right now.
He really loves that thing.
Okay, obviously this is not how we go about investing your money. Don't worry. But it is an interesting video. It's also funny because it really highlights how quickly the markets move in today's world. One piece of data, one signal can move the market in the wrong direction. However, in today's environment, investors and companies often don't wait to investigate. They simply act before thinking. Let's talk about where we are. Inflation. One of the main reasons interest rates remain low and bonds continue to perform well is inflation is still very low, at least according to how the Fed measures inflation. The Federal Reserve would like to see inflation reach 2%, but for the past several years, at least by the way they measure inflation, it's trended well below that. Until this measure of inflation remains above 2%, you can really expect the Federal Reserve to remain accommodative with their monetary policy. Housing. Home sales are a key indicator of the health of the U.S. economy. When the housing market crashed in many parts of the country in 2007 through 2009, it obviously had a large impact on the financial crisis. Many people had borrowed against the rising value of their homes leading up to the collapse, and that caused a lot of pain to many homeowners. Americans, on average, have a large amount of their net worth tied up in their homes, so a rebound in the housing market would have a very positive sign for the U.S. economy. Automobile sales, we're seeing considerable strength here. Light vehicle sales had an outstanding month in May, reaching an 87-month high, seasonally adjusted annual rate of 16.7 million automobiles sold. Now, when we're seeing strong demand for these types of high-ticket items, that's typically a good sign for the health of the U.S. economy, which is driven mostly by consumer expenditures. The ironic part of this is that subprime loans, remember subprime, make up 1/3 of new car sales and 2/3 of used car sales, which somewhat mutes my excitement about these numbers, but nonetheless we are seeing an improvement. We're seeing strong demand for cars. Now, I don't think anybody's claiming the U.S. jobs market is outstanding, but there has been consistent gradual improvement. For the first time since the boom time in the late 90s, we saw 4 consecutive months of 200,000 or more new jobs added. The current unemployment rate is sitting around 6.3%, even lower in Texas. We all know this rate doesn't take into account the millions of Americans that have given up looking for work. That number is really probably closer to 12%. Regardless, while the job market's really far from perfect, the overall momentum has been moving in the right direction. Now, we know stocks have had a tremendous run from the depths of the recession in March of 2009. But one way to look at stock values is to look at what we call the PE ratio, the price-to-earnings ratio, simply the price of stocks divided by their earnings. The forward PE, or what people expect earnings to be, is currently around 16. The 35-year average is closer to 13 to 14, so stocks do trade at a higher than normal price tag. So investors have to feel pretty optimistic about corporate earnings in the future in order to justify the kind of prices we're seeing today. A lot of you are familiar with this chart. This chart uses a slightly different valuation metric called the Shiller PE, developed by famous Yale economist Robert Shiller. As you can see from the bottom half of the chart, valuations for the Shiller PE is in the historically high range. In the decades time frame, we've been in a secular bear market, secular just meaning long term, which began in 2000 when the PE ratio peaked at 44, that whole irrational exuberance. Now, the job of these secular bear markets is to burn off outrageously high PEs over 1, maybe 2 decades, until the PE finally reaches back at a single-digit level from which another secular bull market can emerge. Now, if history is our guide, we may not be done with this secular bear market. The Shiller PE is currently around 25, which is down slightly, but it's still approximately at the level reached at a pre-crash high in October of 07. So even though PEs are substantially lower than they were in their crazy peak, they're nonetheless at the high end of the normal historical range. What this means for us is that above average returns are going to be much more likely to come from the active management of portfolios rather than the passive buy, hold, hope, and forget about it. And as we discussed, Dudley talked about it, we have active strategies to take advantage of where we are to give you the best opportunity to meet your long-term goals. So this chart has a lot to do with why we do what we do. Bond yield spreads are thin. Coming into the year, as Dudley mentioned, more people believe this would be another year when owning bonds would be a horrible idea. The economy was supposed to accelerate. The Fed was supposed to peel back stimulus. And interest rates were supposed to rise. Well, none of this happened. Interest rates are actually lower when they began than where they began this year. Yield spreads, or the amount you pay for corporate debt over government debt, has tightened, which means people are saying there's less risk in those types of bonds. And prices of investment-grade corporate debt have advanced at a similar pace to the S&P 500. Now, again, you hear people sounding the alarm that bonds are dangerous investments because the economy could improve faster than we expect. Interest rates may rise quickly, resulting in severe losses to bond portfolios. Now, whether or not this proves true relies on the health of the economy and the direction of interest rates. Now, to me, it would make sense that eventually they would begin to rise, but we've had this prediction in place now for many years and nothing's happened. People have been wrong. The point is, again, going back to the strategies, we have an active strategy for fixed income as well. We monitor the various segments of the bond market, and we react to market movements to put your portfolios in the best position possible. Now, one thing that had been the talk of the town for a long time has been the amount of volatility that we've seen since the last recession. There was a lot of uncertainty, unprecedented activity. Now things have calmed down, sending volatility indexes plummeting. Of course, until we decided to do this talk, and then things have gone back up. But, and I'm like this as well, but, when the market's too volatile, it makes me nervous, but sometimes when it's not volatile enough, it makes me nervous because complacency may sit in. But you really can't have it both ways. So, until recently, we had seen the markets calming down a little bit, and then we've seen it pick back up here just in the last few weeks. Well, let's talk about what we're watching. What are some things we need to be cognizant of? Well, inflation, central bank activity, of course, geopolitical tension, been in the news quite a bit lately, use of corporate cash, and then elections. Inflation, who's going to get it right? I think these debates will continue to dominate the rest of 2014. Inflation is a key determinant on where the financial markets move next. If the economy begins to advance, then inflation will also likely follow suit, resulting in bond prices moving lower and assets moving out of that space. However, if these predictions are incorrect, as the Fed believes they will be, at least for the rest of the year, then stocks could potentially disappoint and bonds could again shine bright. It's interesting to note that economists have slightly higher estimates for inflation than the Federal Reserve. This is because the Consumer Price Index, which we're all familiar with, has accelerated sharply recently. Only time will tell whether the Fed isn't right in their thinking or if inflation is truly beginning to surface. It's worth noting the Fed follows a different measure of inflation, the price, the personal consumption and expenditure index, and this chart, this measure, is showing much more muted inflation at this time. Now, we all know, though, that everyday people believe inflation is much higher than the market experts because the prices for everyday items have gone up, while the prices of other discretionary items have declined. So if you want a TV or a personal computer, clothes, toys, those costs have gone down, while the cost of everything else have gone up. So for those of us that live in the real world, we're definitely seeing some costs go up. But the bottom line is that there's many different ways to measure inflation, but the Fed and the market thinks it's low, and that's what's important for now. Central banks, earlier this year, the European Central Bank actually implemented negative deposit rates for financial institutions, Leaders of the Eurozone are so concerned about deflation and the lack of economic growth, they're actually raising their incentives for banks to increase lending and for assets to move to more risky areas of the financial market. You can look at this as a good sign because the central banks are continuing to add economic growth, or you can be concerned about the amount of intervention that is still occurring at the capital markets. Whatever your opinion may be, at least for now, each time they do this type of things, it's been a positive thing for the market. But what's scary is that central bankers really don't even know what will happen as a result of their massive quantitative easing programs because they've never been implemented to this extent. We could see massive inflation, it might not do anything, or it could work exactly as they hope. The fact of the matter is nobody knows. Talked about this. Turmoil has hit many areas of the globe so far in 2014, disrupting the financial markets. The most recent example is what's happening in the Middle East. We talked about ISIS, organization that has moved through Iraq and Syria, disrupting the existing government. This has had an effect on global oil prices and has caused some concerns. So far, the United States has chosen to stay uninvolved with military conflicts for the most part. However, if this were to change and the U.S. military were to enter into a sustained conflict, we would expect this to have a big impact on financial markets. And then, of course, we still have Russia and the Ukraine standoff in the news every day, and certainly reason for concern. Last year we talked about how corporations were sitting on piles of cash. We knew it was a matter of time before the record amount of cash on corporate balance sheets would begin to be deployed, and so far in 2014 we're finally seeing it happen. This has been a major source of support for stock prices. Some of the largest purchasers of stocks have been the companies themselves. In the first quarter of 2014 alone, companies in the S&P purchased $160 billion worth of their own shares. The last 12 months is projected to be the greatest 12 months of share buybacks ever. While corporate cash piles did finally decline from all the spending in the first part of 2014, they still have a lot of money. This amount of dry power could continue to provide a source of fuel for markets as companies continue to invest in other companies, new projects, initiate dividends, buy back shares, and maybe even raise wages for their employees. And of course, we have to be aware of what's going on politically. There are 6 seats needed by the Republicans to gain control of the Senate, and early indications suggest this may be possible. Should this happen, could have a big impact on the markets. I think today we've talked about a lot of things to watch for and worry about, but keep in mind that if there's no uncertainty or risk, there may not be much of a reward. You're all long-term investors. The idea is to block out the noise and help you stay focused on your long-term goals and enjoy today. Thank you for your continued support.